Good morning and happy Tuesday, all you magnificent melon heads out there. Today is May 23rd, 2023. And a report out in Bloomberg this morning, Citigroup is saying that there has been $21 billion poured into S&P 500 futures recently, and that long positions now outnumber short positions nearly 9-1. Talk about a top-heavy market. 9-1, the longs outnumber the shorts. Do you think this market might be ripe for a reversal here? Do you think maybe things have drifted a little bit into the greed category? And all things considered, think about everything going on in the economy right now. I mean, we have been conditioned to bad news. But all things considered going on, maybe a little bit of fear might be just a little bit justified. I get I'm a perma bear. I get it. Jack is always negative. It's right here on his sleeve. Perma bear. All right, I own it. But guys, bank failures, liquidity drying up, a tightening Fed, all right, problems with trade, right? U.S.-China disputes are not going away. The China reopening has been disappointing. The number of bearish stories out there, the number of potentially bearish motivators in this market is way out there. The consumer is hurt. The debt ceiling is still going on. And even if we get through the debt ceiling, we've got Janet Yellen and her liquidity sucking vacuum that are going to come through the economy and hoover up $1 trillion just as soon as that happens. And yet the longs outnumber the shorts 9-1 in this market. Tell me we're ripe for a reversal without actually telling me. All right. And that is the big story right now. Meanwhile, the debt ceiling situation, we are no closer to a deal than we were yesterday. 24 hours has gone by with Congress doing exactly what Congress does best. Absolutely nothing. And markets don't care. There's no deal in sight. And everyone's like, that's fine. They're just going to raise it again like they always do. Right? I've been saying for weeks, guys, that's probably what's going to happen. Probably what's going to happen. But I am not willing to bet my life on it that that's what happens. Remember, this is the most dysfunctional Congress we have ever seen. It is amateur hour in Washington, D.C., and everybody is just saying, forget it, guys. They'll handle it. It's a sideshow. It's a joke. They'll get it done at 11:59 p.m. or right before the bell goes like they do every time. Maybe you're right, but if they keep doing it that way, sooner or later they're going to screw this up, guys. So with that, we're going to shrink my big melon of a head, and let's see what's going on in markets this morning, because we've got the S&P 500 is down 13 points, about a third of 1%, at 4,179. The S&P 500 watched that 4,200 level in the S&P 500. That has been acting as resistance for a while now, and we're struggling to retake that here. The Dow is down 130 points, or 0.4%. That's on top of the 100-point drop we got yesterday, so a couple days in a row of declines for the Dow, although it's only 0.4%. Nothing too bad there. 33,154 for the Dow. And the NASDAQ, which was strangely strong yesterday, is down 47 points today, or 0.37% at 12,675. Currently clawing back a lot of the losses. It had opened up a lot lower. In particular, on the NASDAQ, I want to draw your attention to something. First, this is the NASDAQ chart going all the way back to March of last year. Now, we've just broken out of a key level here. I'm going to get my little doodle brush. So we just broke out here. That's a very bullish indicator. But, folks, look what we've got down here. Look at the RSI. It's hard to see on this chart. Let me make that a little bigger. RSI at 70 on the NASDAQ. All right. Talk about overbought. Now, take a look at just a couple of other times when the NASDAQ's RSI has been anywhere in that, around this level. Take a look at back here, back in February. Oh, we had quite a big reversal in the NASDAQ when the relative strength was up into the 70s. Take a look at what happened back in August of last year. Again, NASDAQ puts in a top when the RSI goes above 70. All right, so we are historically very close, at least in the relative strength, which is a measure of momentum. We are very close to a top. Now, take that considering the fact that we just talked about the 9-1 long to short positioning right now in the market. The market is way off sides long right here, overly optimistic. Combine that with the fact that the market is so top heavy that all of these gains in the S&P 500 have basically been driven by the same 7 to 10 stocks, right? The big mega caps, right? The FANG names and NVIDIA, throw Apple in there too. Almost all gains in the stock market this year have been just those few stocks. The rest of the market is actually down a couple of percent. And we are ripe for a reversal here. CNN Fear Greed Index currently sitting at 70. Not quite into extreme fear, but it's up there, folks. And again, if you look at a timeline, here we are at 70 on the CNN Fear Greed Index. Historically, we are very close to a top where the markets would reverse. There's no shortage of technical indicators that says we could be about to reverse in the indexes. Looking over at the U.S. dollar, we've got 103.53 up 33 basis points this morning, around 103.5. So dollar continuing its march higher, broken out of that 101 to 103 level. And one of the things I've been warning about for a while here is if the debt ceiling pops, if the government fails to make a deal, the dollar is going to go higher. And if the debt ceiling doesn't pop and if the government does make a deal, then the dollar is going to go higher. Either way, the dollar is going to go higher. If the debt ceiling pops, I think the dollar goes way higher. But Janet Yellen borrowing $1 trillion just as soon as she gets the go-ahead from Congress, what's that going to do to the demand for dollars? That's going to raise it up. That's going to raise the price of dollars. So Janet Yellen, I did a video about this last week. Janet Yellen and her $1 trillion borrowing binge, that is coming just as soon as the debt ceiling is behind us, is going to drive the Dixie higher. It's going to drive interest rates higher, and that is not going to be good for this economy. Nobody's paying attention to that right now because everybody's just saying number go up, debt ceiling is a sideshow, forget about it. It's going to blow up in their face, folks. Looking over in the bond market, we've got a 10 basis point drop in the yields on the 1-month Treasury. That's people buying the 1 month. Yields dropping means prices going higher. So for some reason, people are confident in the 1-month Treasury this morning. Everywhere else, we're looking at yields going a little bit higher this morning. We have got the 2-year is yielding 4.36. That's up 5 basis points. The 3-month is up 9 basis points this morning at 5.37. And the 10-year creeping up ever higher at 3.73, up another about 3 basis points. You know, that's been slowly creeping up, that 10-year yield. Keep an eye on that one. It's down well off its highs from last year, but it has been chipping away and reclaiming some of those losses in these last couple of days. Looking over at the commodity board, I see a lot of red. We've got gold is down another $7 this morning at 1,970, down about 1/3%. Silver not doing so hot this morning at 23.61, down 24 cents or about 1%. It was down 50 cents at one point. Again, stronger dollar, not so good for precious metals, nor is higher interest rates. Crude oil WTI is at 72.72, up 67 cents or 0.93%. Speaking of crude oil, we had this story today. Saudi energy minister tells oil speculators to watch out. The prince blames volatility on consumer forecasts and policies, and OPEC Plus to review production policy at a meeting on June 3rd and 4th. Saudi oil minister is telling everybody, hey, we're probably going to cut production in a couple of weeks here. And he's using some rather hilarious wording. What was he saying? I keep advising them that they will be ouching. His words, not mine. They will be ouching. They did ouch in April. Bunch of ouchers they are with their ouching everywhere. Saudi Energy Minister Prince Abdulaziz bin Salman said at the Qatar Economic Forum in Doha on Tuesday, I would just tell them, watch out. So OPEC Plus is telegraphing an oil output cut. Another one right now is what they're telling us. Now, I've not been very bullish on oil for the last couple of months because I look at what's going on with the American consumer and what the economic data is telling me and the slowdown in almost all facets of the economy, and shipping between China and the U.S. is way down. And that tells me we are going to be using a lot less oil. So these cuts from the Saudi energy minister and the cuts that Russia made last month, these are just all about maintaining prices where they are. I don't think it's going to be enough to send prices marginally higher. We'll see if that changes. I don't know how big the cut is going to be. But right now, demand is slowing at about the same rate production is. So the price is basically unchanged. All right. Moving on, we have got the main story today. Citi says buyers plow $21 billion into U.S. stocks. Some $21 billion of new long positions has been added to S&P 500 futures. The S&P 500 is near a key breakout level of 4,200 points. Investors are boosting their bullish bets on U.S. equities, making positioning increasingly one-sided, according to Citigroup strategists. One-sided is one way you could phrase this. I like to say off-sided is how you could better describe this. Market participants have added $21 billion in new long positions on S&P 500 futures, Citi's data showed. Even as talks in Washington to resolve the debt ceiling impasse drag on, the weekly flow of new longs was one of the largest seen in recent years, it added. Why are investors so optimistic? I just don't get it. Hey, I'm predispositioned to negativity when it comes to the economy, folks, but Where is all of this bullish sentiment coming from? Somebody help me out. Let me know in the comments. Where is all of these rose-colored glasses coming from? And this just amazed me. The momentum is clear and positioning is increasingly one-sided. Longs outnumber shorts by more than 9-1. Folks, when everybody is long, when your taxi driver is long, it's time to get short. Okay, I'm not telling you what to do with your money. I can't do that. I don't have the permit from the government that says Jack has permission to tell you what to do with your money. But I can tell you, when longs outnumber shorts by 9-1, the market has a problem. This market is so offsides, it is ridiculous. The few remaining shorts are all in loss, but a short squeeze is not likely to significantly impact markets. That's modestly put. There's no such thing as a short squeeze when the longs outnumber the shorts by 9-1. This market is so ripe for a reversal. And what could be one of the things that reverses this market? How about Lowe's? Another story of bad retail data. Lowe's cuts full-year sales forecast as spending on do-it-yourself project weakens. Lowe's cut its full-year sales outlook. The home improvement retailer beat first quarter earnings, which were very low. The company's shares dipped in pre-market trading. Lowe's cut its full-year outlook Tuesday as lumber prices fell and do-it-yourself customers bought fewer discretionary items. The home improvement retailer lowered its forecast even as it beat Wall Street's revenue and earnings expectations for the fiscal first quarter. Net sales. See if you can notice some recurring themes in some of these retail companies that I've been talking about in the last few weeks. Net sales fell nearly 6% to $22.35 billion, from $23.66 billion in the year-ago period. Comparable sales, i.e. sales at the same stores or online sales versus the same period last year, dropped 4.3% in the fiscal fourth quarter. Now, fiscal first quarter. Keep in mind, folks, comparable sales need to rise at least 5% just to keep up with inflation. These are down 4.3%. So Lowe's is selling a lot less stuff, folks. That's lower than the 3.4% decline that Wall Street had expected. So we can add Lowe's to the pile of retailers who are getting clobbered. I mean, just look at some of these numbers over the last 2 weeks that have reported. I've got Lowe's, net sales down 6%, comps down 4.3%. Foot Locker, earnings per share down 56%. Same-store sales down 9.1%. Target, flat comps, flat sales. Home Depot, earnings per share down 13%. Same-store sales down 4.5%. Walmart was the only outlier in this group. Walmart did okay because of their successful pivot to grocery, and they have seen the benefit of consumers being driven out of other stores because they can't afford to shop there anymore. They're being driven into Walmart. So Walmart has been the silver lining to this big gray cloud of suck in retail. But the American consumer, folks, he is tapped. And Lowe's, Target, Foot Locker, Home Depot, right? What do you got there? You've got a big box store, general merchandise. You've got 2 home improvement stores. Bad news for housing, by the way. Foot Locker, absolutely dead. That's apparel. I mean, all of these different categories, they're all taking it on the chin, folks. So pay attention to this one. American consumer, we are a consumer-driven economy. Lowe's stock is actually up 1.6% this morning. Why are they up? Good question. Why? Because number only ever go up. Also, one last point on the debt ceiling, folks. We now have $60.6 billion left in the Treasury General account. That was their closing balance as of, I believe, the 19th of May. It went up by a few billion dollars, currently at 60.6, but the clock is ticking on the debt ceiling. And I have a couple of thank yous I got to send out here. Let's say thank you to Mr. Steve Woitis. Thank you, sir, for the super chat. Copper now at a 6-month low, calls BS on strong economy. You know, copper doesn't lie. Copper is your housing. Copper is your electronics, right? Just about everything has either a wire or a pipe in it. So you're absolutely right, Steve. Copper is a very good barometer for the health of the economy. And copper, along with lumber, right now are not saying very good things about the health of our economy. Great point, sir. And thank you very much for the super chat and the support of the channel. And thank you, Van E. or Vane. I'm not sure. We'll say Van E. Thank you, Mr. Van. He says, would a default cause mass bank failures? You know, nobody knows. Nobody really knows. I mean, there's so much doom and gloom. Let me just posit this. What if the default happens and nothing? Right? Because everybody knows it's only going to be a few more weeks before they finally get something done, whether they 14th Amendment it and we go to the Supreme Court and fight it out, or whether they don't have a deal and they negotiate for a few days. Say the government misses a few payments. All right, interest rates probably go higher. The Dixie probably goes higher. Stocks probably sell off a little bit. But what if the world just goes on? Kind of takes the wind out of the sails of that doom and gloom a little bit, right? Is this Jack being optimistic? Wait, what? What? Somebody take my temperature here. Do I have a fever? What if the debt ceiling pops and everything's okay? Because everybody knows they're probably just going to raise it a few weeks later. Now, that's not to say, yeah, we could have widespread bank failures, right? Because the banks put our money into treasuries. And one of the reasons why we're seeing a lot of banks fail right now is because those treasuries are worth a lot less than they used to be worth because of the Fed's rate hikes. Well, if the U.S. government defaults, I mean, technically, if the government just permanently defaults, those bonds become worthless. The government's not going to permanently default. But the interest rates, the borrowing cost will go up. If the interest rates go up, those bonds will become worth even less. Maybe not worthless, but worth less. And in that situation, that could lead to more bank failures, probably does lead to more bank failures. So, I mean, I don't want to be totally rose-colored. Hey, the debt ceiling pops and nothing bad's going to happen. But what if? Just throw it out there. So we won't know. The U.S. has never outright defaulted. We have defaulted on gold certificates. We've defaulted on the money before. We've defaulted on the gold window in 1971, when we went to full fiat and went off the gold standard. So we have defaulted before, but we've never outright defaulted. So nobody really knows what that looks like. But thank you, Vanny. I appreciate the super chat, sir, and the support of the channel. And thank you, EC660, who came out from under his rock again. He says, hope is not the best strategy. Amen, Reverend. This market, but I will tell you that hype apparently is the best strategy, EC660, because that's all this market runs on is hope and hype. Just sprinkle some AI on whatever bad news. As long as there's an AI in there somewhere, your company's going to add $100 billion in market cap. That's all it takes, right? And again, this whole run in the markets, this whole run in the S&P 500, sitting around 4,200, it's all been the same 7 to 10 stocks, and it's all just the AI names. It's just AI hype has taken this market up higher, created trillions of dollars in new market cap. Something like $2.5 trillion of market cap has been added to just the AI companies like NVIDIA, Microsoft, I think Meta and Google are also investing. Just the AI companies, $2.5 trillion in market cap. Not sustainable, folks. It's just not sustainable. Hope is not a strategy. Hype is not a strategy. Stock valuation should be determined on how much money does your company make. Right now, look at all those retailers. Companies are making less money. This market is too top heavy. The indicators are there. The bad economic news is there, folks. Market is ripe for a turnaround. Full disclosure, Jack is a perma bear, and I tend to be negative all the time, so you got to take that with a grain of salt. I always encourage you guys to go out and listen to people who say the opposite. Maybe go watch Meet Kevin or some of these guys who say we're going onward and upward to new highs. Make up your own mind, folks. I just got to call it like I see it. So thank you very much, everybody, for the super chats and the support of the channel. Thank you to my Patreon supporters very much. Looking forward to talking to you guys tomorrow on our weekly Zoom call. The link down below, should you feel so inclined. I'll be scheduling that one today. And, I saw somebody just snuck another one in there. Where are you? Somebody just snuck another super chat in there at the last minute. Here we go. Mike Bender. Thank you, Mike, from Robin RC. He says, Fed policy wrecked 10 years of bad investments via inflation control hikes. What happens if QE and higher interest rates come along? Well, Mike, all I can tell you is if you're driving your car and you go pedal to the metal on the gas pedal and pedal to the metal on the brakes at the same time, I can't tell you exactly what's going to happen to your car, but I can tell you your car's probably effed, right? If you slam on both pedals at the same time, something bad's going to happen to your car. I couldn't tell you exactly what's going to break first, but something will break in that scenario. QE and higher rates at the same time. Why not? It's the 2020s, folks. But I can't tell you exactly what happens here because those are two diametrically opposed monetary policies that if they were implemented at the same time, it'd be like a kid with, parents fighting in front of the kids. And the kid's just like, I don't know what to do here. So no, I couldn't tell you what happens in that scenario. Just it can't be good for us. So thank you very much, Mike. I appreciate the super chat, sir, the support of the channel. Thank you, everybody, for watching. And until, hi, Mom, hi, Dad. Love you guys. Till next time, live small and dream big.